Welcome everybody to our next webinar here at JFD Brokers, and also in the name of JFD Brokers, a warm welcome to everybody out there. It's a pleasure for me to have you here once again. So many people around, and at least if I look to the names, it looks quite international, so to say. But anyhow, the nationality doesn't matter really, but it's always interesting to see that we have really people maybe from nearly everywhere. I'm not exactly sure. Maybe we can do a quick survey here. You have that functionality of GoToWebinar control panel, and normally you can ask questions there. But maybe you would do me a favor if you just write down where you are from or where are you located. That might be a nice thing, but just as if you want. GoToWebinar control panel reminds me that you will see that I have already uploaded the slides of today's webinar, so you can download them if you like. And you see already my contact address here. Later I will show a couple of Excel sheets, and if you are interested in that Excel sheets, I will make sure that you get them. Today, or for that webinar, I will not really directly send you the Excel sheets because they are too big, and you might later see sometimes my computer is a little bit slow, but it's simply because of those huge Excel sheets. But you will get a Dropbox link, and then you can have those Excel sheets as well. Oh, I forgot to mention, today is the 26th of April, 2018, 7 o'clock at least in Germany, and I see we have people with different times here. We have people from France, from Bulgaria, from Italy out there, and still some people out of Germany here. That's nice to have those in the English webinar. But anyhow, you know that I have always the same webinar twice, once in German and once in English. So the other one has been yesterday. But let's come to the topic of today. How are these seasonals? Does it work, or how can we do something out of that? Sounds like it's strange title of a webinar. Let me rephrase what we finally will have. We will have the answer to the question, when is the right time to trade for a given forex pair, and in which direction? And that is the answer of hourly seasonals. We go through a sub-universe of forex. In total, I will look to 28 plus 1 forex pairs. The plus 1 is always gold, because I treat gold as a forex pair as well. And 28 is the combination of all possible forex pairs out of 7 base currencies. But that will be the answer. When is the right time to trade which pair in which direction? Respectively, we will use one EMA for each forex pair in order to get that answer, and we will try and we will establish that statistical edge. Another title for today's webinar would be how to find a statistical edge, a probability advantage for trading. And that might be another guide here for you, how to do something by your own for similar tasks, or something really similar. And that's exactly what we do. We go for a statistical edge for trading, and that's exactly what we do here today. And we used that concept already once, and you know that kind of strategy I called DAX day of the week seasonal. And at that point in time, we use an EMA, yes, for the DAX, but on a daily base. And we use the day of the week as an additional filter for trading directions. And today we do something similar, but we will not use the day of the week. Instead of that, we will use the time. Do we have 1 o'clock, 2 o'clock, AM, PM, and then ask exactly the same kind of question. So that's how it works today. But first of all, I have always to show once that slide here. We talk about trading strategies. And finally, if you adapt those kind of ideas, numbers, I put here my slides. Of course, you trade on your own, you know that, and on to your own responsibility. But that I think is fair enough. Good. A little bit more detail. What is it about today? So we will short recap about seasonals in general, so that everybody is on page here, that we know exactly what we are talking about. If I talk about seasonals in general, and of course I will not talk about springtime or summertime, wintertime. No, it's not meant that way. It's to look for something which is repeating by its own, like to have summer, to have winter, and so on. So that's the basic concept, and yeah, let's do that later. And when I started the investigation of hourly seasonals, I just created two additional charts. Let's call them preliminary considerations here, and it's simply the answer to the question: at what point in time we have the biggest moves during the day. And even that might be of interest as well if you have strategies who look for more volatility, more moves, then that will be the answer as well. And then we do exactly that transfer of DAX daily seasonal to the H1 Forex market. So H1 stands, of course, for the time frame. So we look for hourly changes, and we will look for the Forex markets here, as I mentioned. I will share with you the results and, of course, how to use that concept for your own practical trading. Let's start with a short recap of seasonals in general. And the next three slides are from the original development of the DAX Day of the Week seasonal. And what we have here is what I call the mother of all seasonals. And of course, if I talk about seasonals, then the best is to talk about climate. And what you see here is the climate situation where I live, that's in close to Dresden, and the recordings are done at the airport, that is Dresden Klotsche. Anyhow, what do we have here? Of course, we have the temperature during the year from for each month, daily high and daily low. And there's an additional thing here, how many days we have below zero. Anyhow, that's typical what we have here. In summer, temperatures are high. In winter, temperatures are low. Okay, I know that's nothing new. And you might say, yes, I know that. But how's the concept? If you get the task to predict the temperature for July, this year, then for Dresden, then you will have an immediate answer. I would predict 24 degrees. That's easy. And that's exactly what we do with that. We know you would not come to the conclusions, I predict for July in Dresden 10 degrees. Definitely no. And you know that you are much close to the actual values if you go for something like those mean figures we have within that chart. And to say 5 degrees for July, no. And we use that kind of repeating behavior for climate, and later we use it for trading. And the basic idea behind is that things repeat. Why can we say even at stock markets or forex market that things repeat? Think about what is it? What are the drivers for what we have within our markets? Finally, it's always fear and gear. That's two elements which control a lot. And since that element is not changing, it was the same 10 years ago, it was the same 100 years ago. So, therefore, I think to say markets repeat is not that bad. Okay, that is climate. That's easy. That's easy stuff. The first thing we can go here, in order to go a little bit more to markets we are used to, is the most well-known stock seasonal, and that is what's called the Dow Jones 4 years election cycle. The story behind is quite simple. We know that every 4 years we have elections in the United States. And the author here has divided the period of election in, let's say, 4 sub-periods. The year of election, the post-election year, the midterm year, and the pre-election year. And then he did an analysis for the last 100 years of Dow Jones. And that is the answer. So we have a typical behavior for the different years of election or within that 4 years cycle. And you see, for example, that the third year here is more or less a flat year. So within that year, to go long, it's not the best idea for Dow Jones. But, for example, in the pre-election year, first half of that year, looks great to have strong movements to the north. And that's what you can do with that kind of statistics here. So it is a seasonal because something repeats, in this case on a 4 year period. And we can use that as a statistical edge for trading. And that's what we try to achieve. So from now on, I think in 2 years, we should go long for Dow Jones. That's a statement out of that kind of chart. But now let's talk about the problems with those kind of seasonals. At least I have a problem with those kind of seasonals. And my problem is that the statistics behind are in most cases really pure or weak, however you call it. Look, for example, for that picture here. Of course, we have 100 years Dow Jones, but we use a 4-year cycle, so that means we have more or less an average only of 25 numbers. To have something out of 25 numbers called statistics is always not that good. So if we look for long-term seasonals, like other people are doing in terms of winter, springtime, or something like that, and use the last 20 years, so they have always the same problem. The statistics is really pure. But how can we improve it? Oh, before that, we have another problem. And the other problem here is, especially if we look for underlyings like indices, Dow Jones, DAX, or something like that, then we have the overall trend behind. Of course, we know that during the last 100 years, the Dow Jones has been constantly increasing. Okay, there are dips like financial crisis 2008 or something like that, but we have an overall trend, and that is behind that here as well. So that makes this picture even more strange or more complicated. Solution? You go for smaller time frames or other kind of seasonals, like we did already for the DAX seasonal, because there we investigated the individual day of the week, and we have 52 weeks. That means we have 52 Mondays, 52 Tuesdays, and so on per each year. And if we now do it for, let's say, the last 20 years, then we have at least 1,000 data points. That's much better than 25, like here in this. And today we go time frame lower, and then we have an even better statistic. It's not that huge better because we go for the individual hours, like this, 1 hour, 2 hour, and so on. So we have 25 per day. And if you go for the last 10 or 14 years data, then you have about 4,000 points per each hour. So statistics will be about 4,000. But back to the trading setup we have already introduced. Finally, how did it work? Because we use later the same kind of concept, therefore I repeat that here as well. We use an EMA as a pre-filter. And we ask ourselves for the DAX day of the week seasonal, is the open of the current day or the day of interest, is that open above or below a certain EMA? And in this case, it has been a period of 40. And if the answer is we are above that EMA, we simply call that market situation a bull market. That's maybe a weak definition of bull or bear market, but it works. And I don't care really about it. It's more to separate the one from the other. And that separation is done by looking, is he open above or below that EMA? And in case we are above, then we have 3 days, Monday, Thursday, and Friday, we go for long. And on the other 2 days, we go for a short trade. And in a beer market, it's exactly other way around. We open the trade, we have a stop loss for the trade, and if the stop loss has at 10 p.m. German time not reached stop loss, then we close the trade. We don't have a take profit. That's all. Strategy works great. That's the reason why that strategy is part of the JFD basket portfolio as well. It really works great. It's that simple, and we try to do now the same stuff for Forex, but one time scale down the road, meaning H1. Okay. And in principle, we try to adapt everything like this one here. As I mentioned, I want to share with you 2 results before that. So those are general considerations on how the market moves and when. And let me explain a little bit more what we have on the axis here. The x-axis, you see numbers like, and I explained it, especially the reason for that is we have later always that kind of x-axis or separations. So if you go for, we have a 0, 1, and up to 23. And what does it mean? Simply, the first point here at 0 is the move, the percentage move between 0 and 1 o'clock. So I measured the percentage move from open to close, or better, other way around, close minus open divided by open. So then I have a percentage move, and I went for the absolute numbers, so everything is positive, no consideration of direction of the move, whether it's a long or short move. And then I average everything along the last 14 years for each individual hour. So once again, x-axis are hours. So 11 stands for 11 o'clock. And all numbers here is always German time. So if you are living in another time zone, then you might have to shift it here. So everything is in German time here. And y-axis, is that average of percentage move, in this case, the absolute move. And of course, we can see waves, and that wave kind behavior is really, I think, standing for the 3 different regions of the world. So starting in the early morning, so let's call it the Asian session. The Asian guys start trading, and that already increases the average move. And then at 8, 9 o'clock, the European take over. And then later, the United States comes on top. And therefore, finally, we have the highest moves percentage-wise within the time frame between 2 and 5 o'clock. So that's a little bit like the average volatility. And the other thing, which is quite interesting here, is if you look a little bit more in detail, and you can have the Excel sheet of that as well, so then you can better differentiate between the different colors and symbols. But I can tell you at least out of my head that on top of all here is gold. So the biggest moves we have percentage-wise in gold, and that's exactly that line here, that brown line. And the smallest moves we have in euro, Swiss franc. So that's as expected, and I think next to that is something like euro, British pound. I think that is that blue here, and so on and so forth. And the other one, which are more pronounced to more moves, bigger moves, are those related to currencies with Japanese yen. So we have that three-wave behavior, Asian, European, American. So that helps maybe everybody when it comes to the question, hey, if I need volatility, you have the answer here. And that was an absolute move. But now I did the same and average really the moves within or including the sign, because sometimes we have positive moves, when sometimes we have negative moves. That picture looks noisy, and the only reason I show or share that picture with you, it's what I call a little bit like an artifact. So we have the different symbols here, and what surprised me, because I expected that noisy behavior, no special direction at a certain time, because we are looking for 29 different forex pairs, and along the time or the time of the day, and I would not expect any bias for anything. But you see, at 10 o'clock in the evening, most of the forex pairs in average go south. So you see that peak here, and that surprised me. And yesterday I asked already whether somebody has a good idea why that might happen here. And maybe I can tell you a little bit here. The order is that the biggest move at 10 p.m. is Canadian dollar, Swiss franc, and then some other currencies with Swiss franc are here. So why the hell do we have a bias south for those forex pairs? It's really surprising. And somebody yesterday gave me a very good hint why that might happen. And the reason behind is we have that spread widening. So the spread goes up, and that means that the bid price is maybe going a little more south. And since we have only the average for the last 14 years here, so in average we see that spread widening. That might be the reason, I have no idea, but that would not explain the 3 o'clock one. But anyhow, let's just keep that here as an interesting example. The other one is much more meaningful, because then we have the average move. But now we want to know at what point in time at the day, for which forex pair we should go for long or short. Let me explain how I did that kind of analysis. So once again, I start with an EMA in a chart. I'm not really looking to charts now, because I do that analysis for the last 14 years of historical prices I have. But we use that EMA once again to separate our markets into something more bull or bear market. So, and we investigate those independently. What do I mean? I have two possible situations. At a certain point in time, let's look for the three o'clock candle in the morning, and at 3 o'clock we look whether the open of that candle is above a certain EMA value or below a certain EMA value, and then we do that averaging independently for the one which are above or below that EMA. It's only for separation purpose later. And that kind of investigation we do for, let's call it all 24 hours. So we have 24 candles a day, and we do that kind of investigation independently. So the target is later, maybe we will realize that for just fictively now at 3 o'clock, if we are above EMA, then the gold price for the next hour has an edge to north. That would be great. If we know something like that, or another example, that at 10 o'clock, if euro US dollar is below a certain EMA, 20, an EMA 20, then we can expect that we have a statistical edge that the price goes within the next hour, typically north or maybe south, but we will know that. That's the kind of statistical edge we try to derive here. The question, at what time at the day and with what EMA we have an edge in the long or short direction. And somebody's already asking, what is EMA or what is EMA in general? Oh no, so it's not the EMA period; it's just the EMA itself. So EMA stands for exponential moving average. That's the abbreviation for that, and you find that within any chart software. So, for example, if you look for that chart here. Just an example. We have here Euro, British Pound, and you see that red line here. And that red line is an EMA, an exponential moving average. And within the chart software, you have it here under indicators. And then we have moving average. And if you throw that indicator here, then you can manipulate the period. And later I will talk about EMA periods 50, EMA period 100, and that's exactly that number here. The only thing which is wrong for my investigation with respect to that chart here is we do everything for H1. And then we look, for example, for that point in time here, we have 3 o'clock in the morning, and you see big move to the north for whatever reason. No, I think maybe that's the wrong time. It's anyhow. So that's the story about EMA. Okay. So the final thing we want to know is that kind of edge for a certain situation above or below EMA, and then what is the most probable next candle? Is it a long candle or is it a short candle? And let me directly jump into what I have done, and let me explain that kind of Excel sheet, and I will enlarge it a little bit, and I hope you can follow me right away. First, in that line, I have done the analysis for gold, as you can see from the symbol, and later within that table, and you can have it, you will find for all EMAs those specific values, but at the head of the table, there are the best ones, the best for each underlying, and you can see already, okay, the best EMA to get the best separation for the best hour would be an EMA of 151, or if you use 150, it's more or less the same result. But anyhow, but now let's go a little bit deep into that table here. Because you will see the numbers later more and more often here. So if we have within that column, that's a 0. So it's a 0 o'clock, if you say that. So it's the beginning of the day. I'm not sure whether one could call that 0 o'clock, but anyhow. So that's the time. And if you have a number here like a plus value 0.02, what does it mean? It means that if the open of that candle at 0 o'clock is above an EMA 150, then typically the candle is a long candle. So you see within my Excel sheet here we have above EMA. So all those numbers here are values if we are above that 150 EMA. You see, okay, the first hour of the day would be a long candle, and the second hour at 1 o'clock would be slightly short, and so on and so forth. And then we can go through that table and see, or we can look for what I call what is the best. Oops, that's not. So what is the best candle for a trade? In principle, you can see some prediction here for any hour. So you can ask even for 11 o'clock, for 12 o'clock, for 1 o'clock once again in the afternoon, and so on and so forth. And always, what if our open is above a certain EMA? And then you can see the typical direction. But later we think about trading. So we not only need to have the direction, we need strong moves. So we would look for numbers which are huge within that investigation here. But that's what we do next. We simply jump into what's the best number. And the other step we will do in a minute is we will look for equities out of that kind of analysis to see if we would trade it exactly like that, to say, okay, at 12 o'clock, if the open of the candle is above that EMA, we go long. And then we look for the equity of the last 14 years. But here you can see I have done this analysis for being above the EMA, and sometimes it would be a good idea at some point in time during the day, it would be a good idea to go long, and at other hours it would be a better idea to go short. And the same I have done for below EMA, because of course we can our open of that candle can be below a certain EMA, and then we have the other numbers. So you see here already that statistical edge. Sometimes it's going long, sometimes it's going short. And I have been interested in what are the best times for each Forex pair. And that kind of analysis I have already summarized for you within one slide. And let's directly look to that. And you can see here the summary. For gold, the best EMA is 150. The best time of the day is 2 o'clock afternoon. At 2 o'clock in the afternoon, we would have to look above or below. And if we are above the EMA with our open, then, and that is meant here by that +1 instead of -1, it would be a good idea to go long for exactly 1 hour. At least that's the kind of investigation I have done. Just going for 1 hour long. And if you would be below that EMA, it would be a better idea to go short. And you see another symbol like British pound, Japanese yen, then the best separational EMA would be an EMA of 50. And the best point in time for a trade during the day would be 4 o'clock. And once again, above, we should go long, below, we should go short. But sometimes it's vice versa. For example, next one here, New Zealand dollar Swiss franc, EMA 7, we should trade at midnight. Okay, that might be not the most time in favor, but at least the analysis is done that way. And you see for each Forex pair, the EMA is the best point in time of the day to trade. And we see some good examples like in the afternoon, Canadian dollar, Japanese yen, euro, Japanese yen, 4 p.m. Great. We can use that. That's the statistical edge. But that's not all. We need more. Whenever it comes to statistical edge, the next question is that edge big enough to even earn the costs of trading as well? You know that we have seen thousands, or that's maybe too much, but of strategies which have a statistical edge. But when it comes to trading, so when we incorporate the costs of trading like spreads, commissions, those strategies break down. So they do not work anymore, since we have at least to earn the costs as well. And you know, whenever you open a trade, you are instantly in the minus, at least by the spread. So that's what a lot of people unfortunately forget. So therefore, we have to look not only to the edge, that we know we have that statistical edge, we have to look for the equity, and we have to include the spread. Definitely. And of course, we are trader. We would like to see equities of that kind of strategy. An equity would mean to trade exactly that rule, like in that table here, every day. Always for gold at 2 p.m. we make our decision, long above, short below EMA, and then we want to see the equity of that kind of strategy. Okay, let's prepare for that. So more or less everything I mentioned already. So up to now we have only the edge, so we know the typical movement, the direction of the move, but we need to incorporate the spread as well. And maybe another idea. For a normal trade, we can set a stop loss. So maybe it's a good idea to have a tight stop loss for that kind of strategy as well, because we can use that stop loss. And maybe from time to time we reach a stop loss level, but for all other, we just wait to the end of that hour and then we stop out that trade. That's the philosophy of the next Excel sheet, because we want to see equities. Let's go for that. And I hope my computer is fast enough that we don't have that often a set clock here. Let me explain a little bit how that sheet here works. Or maybe let's start with the equity, because I think everybody is looking already to those equities. So we look for the last 14 years of data, and you see already that I started with 2004 with the data here. And I simply summed up all those percentage moves for that kind of rule I mentioned within my last slide. So we use an EMA of 151. So we use the time 14, and we use the time for the same time for being above EMA or below EMA. And the equity has 3 lines here, because we for each day we have one of those 2 situations. At 2 o'clock, we might be above EMA. Then we go for a long trade, and therefore we have that direction above +1, because we go for a long trade. And if we are below EMA, we go for a short trade. And you see the individual equity for all above and the individual equity for all below. That's the red one, and instead of the blue one. And of course, we can sum both up, and then we get the yellow one. It doesn't look that bad. It's a nice equity. Anybody, I think, would like to have within his trading account. But a short view on how I do that kind of calculation. Of course, I start with those hourly data, in this case, gold prices. All the data have an open, a high, a low, and a close value, like always, for an H1 candle. And then I do all those calculations like, am I above EMA, yes or no? Am I exactly at point in time, in this case 2 p.m.? And then I go for the calculation of the trade, or in this case, it's not a real trade, it's just the percentage change, and then summing up. That's how that Excel sheet works. And you might use the same Excel sheet for other underlyings, then you have to exchange the data. And you might use it for other EMA values. You can try by your own if you like. You can go for other EMA values, or you can go for other times and other directions. But now, as I mentioned, that's only statistical edge. Now let's go for spread. So, because we open the trade at the open of that 2 o'clock candle, and we close the trade at 3 o'clock. That's not a long time period. So the price doesn't have that much time to change huge. So the spread definitely will make our result worse. And now you see we have to wait a little bit. So I changed the spread from 0 to 0.1, which is okay, at least at JFD. And you see, we lose already some profits here. And that's simply because of spread, because spread always works against us, and we have to pay that spread. And if I go for even 0.2 spread, result will be worth a little bit more, but still profitable. The good thing is, and now I come to the right-hand side of my Excel sheet, I said, let's introduce stop loss as well, because we can use a stop loss value. Let me change spread back to something which is typical at JFD. That is 0.1 for gold. And I use here a stop loss level of 0.4%. What does it mean? We would open a trade at, let's say, gold price of 1,200, and then our stop loss would be in a distance of 0.4%. That's all. And then if we have a stop loss, of course, we can calculate all trades in that universal unit, which is called R. That's a single letter, but it stands for, if we reach stop loss, then our trade would be a -1. -1 R. And profits are measured in the same unit, just in R. The good thing about that is, if you do it, you can multiply with any euro number, then you have directly an equity in euro. So in this case, that equity here is in R. And if you multiply it with 100 euro, which would mean that you always risk 100 euro for each trade, then you can put 2 zeros behind, and they have everything in euro. Doesn't look that bad. So we can change stop loss and try to improve equity as well. But that 0.4% is not that bad, I can tell you. But you see, we can use stop loss to a little bit further increase the equity. And it's more like a typical trading situation, because as I say in every webinar, if we open a trade, we should know where to put our stop loss. And that's what we do here. and the distance would be 0.4%. Doesn't look that bad. And especially, even if you go for higher spreads, you will see that since 2006, the equity is constantly increasing, which is fine. And the reason a little bit behind that, especially for higher spreads, that in the very beginning of that equity here at 2004, we suffer from a totally different situation. At that point in time, the price of gold has been 400, and a spread of 0.2 is percentage-wise bigger than as today. So it's easier today with a spread of 0.2 to earn money than at a gold price of 400. And you see then we have a good increase in equity here as well. So strategy works even with a real trade. And the funny thing is, what we would do here, trading that kind of strategy, is we only have to look at 2 p.m. Are we above or below that EMA? We know which direction we go for. And at 3 p.m., we close the trade. That's all. We are only for 1 hour in the market, and that's all. And on the other hand, you can think about, hey, I might use those kind of input, those times, those EMAs, start a trade and further manage the trade discretionary. What would mean maybe after that 1 hour we are in profit. You might go for stop loss increase to break even, something like that, and then you close a trade at the end of the day. You take profit level for the trade. You can just use that one single table as an input for discretionary trades as well. So therefore, that has more than just to have that kind of automated trading like within that Excel sheet here. That is not a single example. That you have at least seen one additional example here. That's the situation for euro US dollar. Looks great again. That means we have a good increase here, a strong probability advantage, different EML value, different point in time. So it might be a nice time for people normally at work over the day, but at 6 p.m. We can go for one single euro US dollar trade. Situation would be if open is above that 44 EMA, we would open a short trade. That's why here we have that -1. And if we are below EMA, we would open a long trade. Those rules really sound trivial, simple. But remember, the DAX day or week seasonal is as simple as that one here, and is already traded since more than a year, quite profitable. Once again, we need to consider spreads as well. So if we go for a spread of 1 BIP, which is fair enough and would already incorporate commissions as well, strategy works still. As you will see in a second, it always takes a little bit time because we have 90,000 candles within that Excel sheet, and therefore calculation needs some time. You see here just the percentage changes, or summing up the percentage changes, and here the results in R, in the risk unit R, and it works as well. Quite well. Of course, we have drawdowns, as always. When it comes to trading, we have drawdowns in our equity, but still it works. And it will work even better if you do more with those trades, because to restrict those trades for just 1 hour in the market some things you don't have to do. We can use that input and take the trade for a longer time if you want. So that's what's behind hourly trading, hourly seasonal, to get exactly that kind of edge for your own trading activity. And let me repeat a little bit here, if my computer comes back, because still it's calculating, or maybe it's just it's a minute here saving the document once again. But normally it only takes a few seconds, then we can go for the next step here. We have the data for all 28 forex pairs, and you can look what is a suitable time frame for you. Maybe you are somebody who is always still awake at midnight. Then you can go for those which start at 0 o'clock here. That's exactly starting at midnight. Maybe you are at working hours not in the situation to trade, but then you might go for those other underlyings like euro, US dollar, because there we have a good time exactly at 6. As you remember, it's exactly that table. And if you want to look much more in details, you can have that previous Excel sheet with all EMA values and calculations for all the other times, other EMA values. So everything is in there. Finally, we know now that we have a statistical edge. We can use exactly that for our trading activities. And all we have to do is, at that point in time, looking to that table, we have to look, are we above or below the EMA? And then we know the trade direction, the preferred trade direction for that underlying, for that hour of the day. And that's exactly what we can use for our trading. You have seen the equities already, which is good. So it's not a single event which works. We have statistics behind. It's always about 4,000 data for each individual hour, which is good. So it's not a statistics like that we have seen for the Dow Jones. So it really works. It works out. Yeah, definitely. And still my computer is working with himself. So I want to have that summary slide here. So we know that the concept of hourly seasonals work. We know the times. We know that we can transfer that to profitable trading. You know the rules for that. Let me emphasize that you should go only for those pairs which have low spreads. Because if you go for something like British pound, Canadian dollar, or Australian dollar, then the spreads are that huge compared to the edge that it will not work for profitable trade on a long run. But still, no one, as in my last line here, no one forces us to close a trade already after 1 hour. I have done all the calculations exactly like closing that trade after 1 hour in the market. But we can use that edge for longer trades as well. And I have done some analysis on that already. It will be a topic of another webinar. Then we can extend our trading periods here and look for even other kind of trading methodologies here. So that is hourly seasonal. So does it work? Answer yes. Let's go for those pairs with low spreads. And we need a good broker for that. And with JFD, we have exactly that kind of broker. So we have been able to transfer the concept of DAX seasonal with a day of the week to hourly seasonals, forex pairs. So we have extended our trading universe to 29 possible pairs. So we have got enough underlyings to even increase our trading activities if we want. And that kind of concept works, and that's good. Okay, that's for today about hourly seasonals and their work. And let's go for the next webinars in May. I have scheduled already 2 webinars as well. You will find them on the event calendar of JFD. If you are interested, just register there as well. And one other remark, you will always find the recordings of that webinar on the JFD YouTube channel, and they will be online from tomorrow morning. And if you want to repeat yourself with one or the other aspect of that video, just take your chance to go for those recordings. Or if you have a specific question, just send me an email to s.friedrichowski@jfdbrokers.com, and I will make sure that you get your answer. Okay, that's for today. Enjoy the evening and see you again, hopefully in May. Bye bye.